Federal taxes have been a big issue in recent news as Republicans in Congress passed amendments to the federal tax laws which took effect on January 1st, 2018. Temporary amendments were made and will likely keep changing with new Congress configurations and administrations. The biggest legislation championed by Republicans for this bill was a corporate tax rate cut which was locked into law for 10 years. Besides the tax cuts, new regulations are being placed that will affect the deductions that American taxpayers can take from their total taxable income. Deductions are when you claim you spent money on a certain item that you, by law, can reduce from the total income reported to the IRS so that the percentage of your income taxed is less. This is not the same as reporting your total taxable income, receiving your taxes, and deducting the amount spent on an item such as charity.
The GOP tax bill has been a major source of controversy over the last few months, as its proponents claim that it revises the taxpaying process and shifts the economic power of individuals and families, while opponents claim that it raises the national deficit and does not help lower-income individuals. Aspects of the bill aim to make taxes easier to file by raising standard deductions and limiting itemization, while also claiming to alleviate the tax burden for lower to middle income families by setting fewer tax brackets in order to allow more deductions for small businesses to promote entrepreneurship. It further hopes to increase American companies and corporations' global competitiveness by reducing the corporate tax rate, which conservatives say burdens them. This decrease in corporate tax rate has the desired effect of stimulating the economy with similar policies to Reagan-era economics. The idea forms around workers and lower-level employees whose salaries may increase due to capital that was previously used for paying larger corporate taxes in a process referred to as trickle-down economics. Ideally, in this switch of policies, employees will have more spending power with this increase in money flow that consumers previously did not have. This decrease in the federal taxes will initially reduce the federal government's revenue, but the possible growth in the economy actually aims to reverse the almost $5.4 trillion national deficit. The bill is met with criticism due to its dramatic drop in the corporate tax rate. Opponents believe that it may not reduce the deficit, but in fact would increase the deficit because there will be less income in the hands of the government initially with this corporate tax rate reduction. Many employees may also get one-time bonuses, but there will be no long-term pay raises seen for lower-level employees liberals are concerned about. Another concern is that many employees may get one-time bonuses, but there will be no long-term pay raises seen for lower-level employees. One thing that liberals have qualms about is the increase in the estate tax qualifications. The estate tax, also known as the death tax by some, is a tax on inherited property that applies to a small amount of very wealthy taxpayers. The qualifications for taxing these ownings was increased to $11.2 million for individuals, which cuts the amount of people paying estate taxes from 5,300 to only 1,700 individuals who will pay this tax. This reduces the federal income from the revenue these taxes previously brought in. Liberals argue that these individuals who own property priced in the millions have enough capital to pay some taxes on these holdings. This part of the bill seems to align with conservative views that when wealthy individuals are taxed less, they will spend more and stimulate the economy more. One of the most important aspects of this new bill are the changes in the various deductions available to taxpayers as well as the amounts of these deductions. The standard deduction was doubled from $6,000 to $12,000 for singles. This is one of the changes created to incentivize taxpayers to take the standard deduction instead of itemizing, which included collecting receipts and notes of purchases. The charitable standard deduction was also almost doubled from $6,350 to $12,000 for individuals. Analysts at the Tax Policy Center estimate that over 50% of tax returners will no longer claim these deductions, which beforehand were itemized, for charitable organizations. While some standard deductions that were hailed by the Republican GOP as beneficial for low-income Americans were raised, other deductions have been decreased or, in some cases, removed outright. State and local tax deductions have been capped at $10,000, potentially increasing the tax burden on those who live in states with high tax rates or those in the higher end of income brackets. State and local tax deductions have been capped at $10,000, potentially increasing the tax burden on those who live in states with a high tax rate or those on the higher end of the income bracket. Taxpayers in states such as California, New York, New Jersey, and Connecticut, among some others, will be hurt the most by this reduction. Because state and local taxes, or SALT, can already cost a middle-class family as much as $12,000 per year, where they used to be able to deduct the $12,000 out of their federal taxes, they now can only deduct $10,000 from their income, and they essentially pay $2,000 twice in taxes, once for local and once for federal taxes. The mortgage interest deduction was also cut to $750,000 from $1 million, allowing those to deduct interest paid on their mortgages for only the first $750,000. This hurts Americans in areas with high housing costs because they can now deduct $250,000 less from their interest rates.
Tweaks to the former tax regulations have been pushed with the intention to make filing taxes more simple for individuals and couples because most people will not donate more, pay more in mortgage interest, or in child care to reach higher than the standard deduction. Therefore, itemizing and the intricacies associated with writing down and tracking every purchase for deductions are obsolete. However, this may hurt charities as people may decide to donate less in particular years with the promise of a large standard deduction. Also, even though this bill was pushed as a higher deductions, lower taxes bill, the removal of key deductions previously taken by middle and lower income families may cost Americans thousands per individual, more than they previously paid due to accidents or medical bills that can be categorized under this deduction. There is only so much speculation we can make about this bill. In the end, all it is just that, speculation. Until we see this bill in action, no one can truly be sure of its impact or consequences. Whether it helps or not is just over the horizon. We'll just have to wait.